There are many cycles in markets and investing, and a very interesting cycle is the value add cycle. Specifically, in our realm of multifamily investing, value add is a very popular strategy where you buy underperforming properties or properties that have embedded upside through interior, exterior innovations, enhanced management, or some other creative way to actually enhance the property's income and therefore value. This strategy was very popular throughout the last market cycle because investors were finding attractive opportunities to do just this thing, to buy the property, renovate it, increase rents, and then enjoy the increased income associated with their business plan, or be able to tap into that increased income through a cash out refinance or through a lucrative sale. So this strategy dominated the market and everyone was looking to get in at any cost. Additionally, over time, there was more and more capital coming into this strategy. And so what happens when more capital comes into this strategy is there's obviously more competition. And it became a bit of a cliche, but in the last, even as late as 2018, 2019, 2020, certainly thereafter, there was a cliche that there's no more value add deals left because everything was already value added. And so people were starting to refer to deals as Frankenstein value adds, where an owner purchased the property, renovated a portion of the units, flipped the deal to the next owner who then did another renovation. And there was lipstick on the pig on top of lipstick on top of lipstick, and deals were just getting flipped. And deals were starting to trade divorce from fundamentals because of the hope of the upside associated with the value add plan, which may or may not have been legitimate, right? The first generation value adds were likely legit and worked out well for the owner who went and took that risk. But then later in the cycle, people were trying to make value adds out of non-value adds, and that's where trouble came. And so when I mentioned the value add cycle, I think it's an interesting thing to think about as to how do these value add deals become an opportunity? So at one point, right, these deals were in need of capital, and there was an opportunity to give that capital to the deal in order for the deal to reach its full potential. And that opportunity only existed to the extent that there was actually a dearth or scarcity of capital in the market. But what happened in the late periods of the cycle of, call it, even back to 2016, people were starting to say things were getting aggressive, but certainly 2018, 2020, and the peak in 2022, there was an abundance of capital. There was an abundance of debt capital by way of bridge financing, aggressive, cheap financing that was willing to lend based on these value add business plans. And there was, of course, cheap permanent financing, and then there was also equity financing. And so all this capital made it so that there was an abundance of capital, and so that therefore any deal that was in need of capital, so any deal that had an opportunity and it wasn't meeting its full potential, the capital would flow to it, and therefore the property would meet its full potential. And that's what you see through the progression of the cycle. You get to the top of the cycle, every deal has been already value added, and there's kind of no value add left. And now we're over 2 years, well, we're perhaps around 2 years beyond the peak of the market, and there's a dearth of capital because we're resetting the cycle. And so over the last few years, there has been far fewer acquisitions in general, and there's been even less still of acquisitions for the value add strategy, right? The majority of transactions over the last few years have been clustered in the Class A, clustered in the best locations and the best assets and in the new developments. And the value add deals, the riskier deals, are being put aside. And there's very little capital available for value add deals. So for now, fundamentals for the last few years have been deteriorating. So rents have been going down rather than up. So investors aren't looking at deals with an exciting eye and thinking, oh wow, I can buy this property, and if I put some money into it, I'll be able to raise rents and maximize its value and unlock this opportunity. Instead, investors have been looking at things from a more risk-averse perspective and thinking, oh, well, I'm worried rents are going down, I'm worried that occupancies are going down, and I want to invest in a more sure thing, like buying a stabilized, newer vintage asset in a core location. So as this cycle is going to progress, the longer this goes on, the more there's going to be a dearth of capital for these older products that are going to then soon become value adds. But in order for them to become a value add deal, there's two big things that have to happen. Number one is fundamentals. So, and there's two components. So there's really three things. There's two components of the fundamental picture. Number one, you have to have this constriction of capital occur long enough to cause physical distress. See, when owners own a property for long enough and they themselves either don't have or don't want to put the money into the deal, there's going to be deferred maintenance that's going to pile up. And the property's condition is going to decline, and therefore the property's rents are going to decline, or at a minimum lag the market. And that's going to then create the delta between the property's condition and its full potential, which then kind of spells value add opportunity. But at the very beginning stages of the cycle, it's only going to spell value add opportunity for the most ambitious, for the most risk prone investors who have the most foresight and are willing to take the gamble to kind of start up this new trend. The other piece that you need from a fundamental perspective is kind of alluded to it, but you need some rent growth. You need the market to be on an upward trajectory so that investors have an optimistic view of the market, because no investor wants to try to invest in a declining market on a value add business plan. So you need the property to have been without capital for long enough to accumulate deferred maintenance and to accumulate a gap between its condition and the market's condition, which, like I said, can only happen when there's a lack of capital, which we have seen for the last 2 years. Bridge lenders are less excited to lend on this sort of product. Equity capital is concentrated on new development rather than on or newly constructed assets rather than value add. So those fundamentals are slowly playing out and creating the value add opportunity. However, the last piece of the puzzle that is yet to happen is pricing. So it takes not just a good opportunity, but a well-priced opportunity for these things to really take place. Because right now there are deals that have had a capital restriction and have had their condition decline, but the seller is unwilling to let that property go for a price that makes the risk premium worth it for a new buyer to come in and take the gamble on a value add business plan. But it's coming. We're in that reset part of the cycle where the value add deals will eventually come down in price enough to justify the work and the risk for the value add. At the same time, rent growth will come back into the market and there will be optimism about fundamentals. And of course, we've had now going on 3 years of a constriction of capital flow to these deals where existing landlords are in financial distress, which then bleeds into their physical distress, because if they're in financial distress and they can't pay the mortgage or they're having trouble with their lender, they're necessarily not going to spend as much as they should on repairs and maintenance, on exterior capex, on replacements, et cetera, et cetera. So all these things are what drive the value add cycle. And then a few years down the road, we'll find ourselves in a more capital rich environment where the value adds are going to be kind of a played out strategy again, where everyone's going to be doing value add. There's going to be all this capital flowing. It's going to be competitive, and the cap rates between value add deals and stabilized deals is going to compress, and you're going to see a smaller dispersion of pricing across asset quality like we saw at the top of the market. So it's a cycle like everything else. It's a boom bust. It's fear and greed. It's the market. And this is a unique value add cycle related to the real estate investment market.